Consumer confidence is weak, capex planning by companies is weak, and if corporate confidence and consumer confidence is weak, what's the risk that that's going to slow down the hard data and therefore ultimately slow down actual spending decisions by companies and spending decisions by consumers? And we're literally, in my view, at the inflection point where we will soon begin to see the hard data weaken simply because of the significant weight of the weakening of the soft data.
We're going to be bringing in luminaries on a regular basis to talk to them about their background and what they're seeing in the markets these days, both from a tactical and a strategic point of view. It is my really distinct pleasure to be working today with Torsten Slok, Chief Economist and Partner at Apollo Global Management. Just so you know, you were recommended to me about 2 years ago by Ben Pace, our Chief Investment Officer. And Ben is, I would say, the godfather to the firm. He's just that person that if Ben says, you've got to get to know Torsten Slok, then I've got to get to know Torsten Slok. And in the last 2 years, approximately, it has been really a pleasure. Those few times that we've interacted one-on-one, I've walked away with some very positive, very distinct images of you. But then I see you all over the place. I see you in print, in media, and I notice the way you speak, the way you carry yourself, the way you interact with people. I am delighted to be here with you. Thank you for joining us.
I'm honored. Thanks so much, Jim, and thanks to Ben, of course, also. It really is an honor to sit in this chair. I really appreciate it.
Let's start, if you don't mind, a little bit about your background. I know a little bit. We share some of our schooling together. I know you're originally from Denmark, but give us a Cliff's Note version of how you come to where you are today.
Yeah, the short version is that I was born in Denmark. I did a PhD in economics, and I spent some time out in Princeton during that. And once I had done that year in Princeton, where I was from 95 to 96, one of the professors said, you should apply for a summer internship at the IMF. And I got a summer internship, and I subsequently worked at the IMF for 4 years. Then I worked at the OECD in Paris. And then in 2005, I moved to Deutsche Bank. And then in 2020, I moved to Apollo. So I went first from thinking I should have a career in public service, in international government institutions, the IMF, the World Bank, the ECB, of course, all institutions that are focused on policymaking and planning. And then in 2005, the opportunity came to get to the private sector. And even better, in 2020, I got the opportunity to come to Apollo. So moving from always doing macroeconomics, but from the government sector to the private sector is my journey.
I want to talk about one attribute of your analysis that I really like and that I'm trying to embrace in my own way of looking at the economy, which is that you do not pick a thesis and stick with it dogmatically. You just don't. If the data comes in, you will change. I have seen you go from the no landing scenario, hey, guess what? The data changes. Now we might be stagflationary. And my question to you on this, and it's something that I think about a lot, because I think if there were an accusation about me, maybe self-made, it's that I stick a little too long on an investment thesis or an economic projection and then have to be sort of cudgeled into changing it when the evidence is overwhelming. So my question to you, number one, do I assess you correctly? And number two, is there a danger in being so flexible that maybe you get whipsawed a little bit?
That is absolutely correct. And that's a really, really significant challenge for everyone in investing. How long time should you hold on to a view, or for that matter, how long time should you hold on to a specific investment? I view it essentially as a scale. And the scale is, in most cases, tipping in a direction that you have a view that this stock will go up or the economy will do certain things. And there's a number of arguments weighing on the scale. Say, I think those arguments weigh more than the arguments that are weighing in the opposite direction. On the other side, let's take, for example, to make this simple, AI. Is AI a good idea today? Well, what argues for AI being a good idea is certainly that it has created some significant innovations with large language models. It's created some significant innovations when you even go to McDonald's to buy your Big Mac. There's a lot of areas in call centers, in large language models, in technology that are absolutely clearly showing that it's a good idea to bet on AI. But on the other side of the scale, what about valuations? Are these companies at the current valuations justifying what they can make of future earnings? That's not already priced in. And you could say, well, valuations rarely matter. Sometimes you could say valuations always matter. But at the end of the day, there's always arguments on both sides for why in the equity space, in the economic space, why something is going to happen or not. And you're absolutely right. Sometimes a trade war comes along and drops into the other basket, and you end up saying, okay, let me now go back to my spreadsheet and my model from the US economy of trying to figure out what does a trade war do to GDP. And you may initially say, this is not such a big deal. And eventually, in my scale, again, as well, sure we'll talk about later, the scale has now tipped towards, you know what, a trade war combined with laying off workers in the government sector, combined with headwinds from lower consumer confidence, lower corporate confidence, decline in the stock market, ends up saying, well, maybe the balls I have now on the left side of the scale are weighing so heavily that I do need to change my view. So yes, I came into this year and we published a view that we thought the probability of recession in the US this year would be 0. And I got a lot of comments from that saying, oh, it's never 0. And maybe it is never 0. But I really thought that the economy had some strong tailwinds. But now we're almost leaning in the opposite direction. Now we think there's a 50-50 chance, and we are moving our view more towards that maybe there's more than 50% chance that we'll have a recession because the facts changed over the last several months. And when the facts change, of course, we also need as investors to think about, we can't move, you know much more about this than me, we can't move our portfolios around 100%, but we can look at our pie charts and say, what is the part of my portfolio that is now going to get impacted if we have a trade war that's going to be more extended? And are those parts then protected by other parts that do well if there is a trade war? For example, if interest rates go up or down, or if the dollar goes up or down, do I have enough international exposure? Do I have enough exposure to certain segments of the stock market that is less vulnerable if there is a trade war? So it's really about constantly evaluating your pie chart and your asset allocation without moving things around constantly, but really thinking about what are the risks that I'm now facing now that suddenly a new factor has come in this case, a trade war.
That was spectacular. You are putting the emphasis on what we believe at Cerity Partners, which is the asset allocation is the biggest decision. Torsten, we could talk for a long time, and I know how busy you are. I know what a gift this is you are giving me and us in spending this time with us. So we better get into it, I think. It being the current state of affairs, you did just sort of pretty clearly tee up where we are. We are in a trade war. And where do we go from here? Now, I know I'm asking you a question that requires a lot of conjecture. And you and I just spoke 5 minutes ago about the importance of data. Everything is qualified in this conversation between two people by knowing that anything can change. Nothing you say is going to be held against you in a court of law, believe me, under the current circumstances. But where do you think we go from here?
So I think the basic premise for asset allocation investing today must be that we assume that tariffs are here to stay. We are now about to enter a period over the next several months where we'll begin to see the actual impact of tariffs on the economy. And that's why my worry for the S&P 500 is that there's more downside. Also, I worry about the spreads in high yield, even it's a little bit more spread widening in IG, simply partly because liquidity is very weak in IG, but also because you have that if the underlying fundamentals are now experiencing the double whammy of not only are interest rates still high because inflation is high, but it's a double whammy of also earnings growth is slowing down. And that means that you will, in my view, begin to see more slowdown in earnings and therefore more negative downside to the S&P 500 over the coming months. We do not have the worst behind us when it comes to the impact on earnings.
Well, you couldn't have said it any clearer. Thank you. You do speak pretty clearly. You just talked about S&P 500 profits, and I think we would agree that profit margins are very high right now. Is that a way to absorb, basically give the consumer some relief, albeit at the expense of the stock market? Banking system seems pretty good. I mean, we're going to get more into that because we do have to talk about the 10-year Treasury yield and the dollar and all that sort of stuff. But before we get that, are there any cushions out
You're
there?
good, because now you're asking me about what about the other side of the scale. I just told you the huge ball on the right-hand side saying this is the reason why things are going down. Another ball in the other side of the scale is certainly that the absorption in profit margins could potentially have some implications. The problem with that from an S&P perspective is that's another way of saying, well, if the E and the PE ratio is going down now because the E has to pay some of the tariffs, then that would, of course, also be something that will make me worried about the earnings outlook. Other things to your list exactly is that we're about to get potentially some fiscal boost. The challenge with this is that the voting and the bill will probably, now we have reconciliation and the budget resolution was last week, will probably only begin to go into effect, meaning be voted on in July. And that means that with a delay, even if we do get some tax cuts, even if we do get some boost to the economy, the delay will be that we will only have the economy then begin to get some acceleration on the back of that in the second half of this year. And already here in April and May and June, we will begin to see some downward pull because of these factors we're talking about. And finally, you could also have maybe some discussion around, well, maybe we will see such a significant decline in tariffs that maybe this shock will begin to just become much, much smaller. In all fairness, I still look at the side of the scale saying the downside risks are more substantial, but there are things that could happen and things you can monitor that could argue for why these risks might not be as bad as the impact of tariffs on its own is suggesting.
So I want to do just a little deeper on the basis trade. This is personal inquiry from me. This may end up on the cutting room floor, to be honest. Either
totally
your
fine.
choice or my firm's choice. The basis trade. Two things. Normally, when a highly levered trade gets unwound involuntarily, normally somebody participating in that trade goes out feet first, speaking figuratively.
Yeah.
Haven't seen that yet, which alarms me because it feels like that means there's more to come. That's part one. Part two is opinion. What economic value is created by hedge funds doing the basis trade?
If you do look at bid-ask spreads in credit have been widening out, bid-ask spreads in treasuries have been widening out, and even in equities, bid-ask spreads have also been widening out, suggesting that there have been some liquidity challenges. But broadly speaking, if you look at it from a financial stability perspective, I am pleasantly surprised at how incredibly orderly everything has been. We have, exactly to your point, not seen any hedge fund blow up. There was something about someone in Japan who might have had some more challenges, but we have not seen in the US, in New York, or in London, or in San Francisco, or LA, any player that ended up not managing their risk properly. So the first answer to your question is that it is actually good for financial stability, and it's good for markets that markets are actually working despite this dramatic shock that we've been through for the last several weeks. To your question about what value does it add, well, there's a lot of things in financial markets and trades that people put on, not you and me and our institutions, but others that are much more speculative in nature, betting on all kinds of things. Again, back to my 4 screens between what's going on in rates markets, in FX markets, in credit markets, and equity markets. And if you have certain cross-market bets, of course, then you can certainly have, if there is a shock suddenly happen, and suddenly, say, risk managers say, we got to get our risk parameters down, that you can have that things can become more turbulent. And does that add any value? Well, it adds value in the sense that we want financial markets that function, and we want people to make the bets that they want to make. And as people often say, some people in financial markets make money, some people lose money. And if you want to bet certainly on something happening, then the markets are there to give you that opportunity. And as you and I can quickly also agree, you and I and our institutions are not aggressive risk takers. We are capital preservationists, making sure that the money stays stable and gives you a steady cash flow over the next many years without taking dramatic bets. If people want to do that, I love the adrenaline rush from looking at NVIDIA and does it go up and down. And we all have a small part of our portfolios, I'm guessing, in that part of the world, but it should not be by any factor the main thing that you are doing.
That was very diplomatically handled. I'm going to pull back the snark on my part, which was a little bit obvious there. But let's talk about our two firms. I'm really, really proud to be with you today. I'm proud to have both of our firms up here. I decided to drink from the Apollo Cup instead of the Cerity Partners Cup. You know, we've known Apollo for 35 years. I think it was started in 1990. But really in the last few years, it has grown really rapidly. To what do you attribute the success? I mean, it really is now on the top of the mountain. It is uttered in the same names as legendary private markets firms, the Blackstones, the KKRs of the world. To what do you attribute this rapid, the last few years of success?
I think there's a number of factors that play a very important role. But one very important role is that it has become much easier for ordinary households and for investors to get access to private markets. It used to be private markets was for a smaller group, but now the democratization of access to private markets has played a very significant role and is playing a very significant strategic role in how we think about the future of Apollo. And the reason why that's, of course, also helpful is that means that the investment opportunities in private credit, in private equity, in secondaries, in hybrid value, of course, those opportunities are still here, especially in more stormy environments such as the one that we're looking at the moment, because we're having a significant amount of turbulence in markets, and that's when dry powder, people with a long horizon, people with a cool head, in my view, will, of course, tend to benefit because there are more opportunities coming around when you have forced sellers. So one very important part of what we're doing is indeed to have given more access to a broader range of investors to what we're doing.
Torsten, this may surprise you, but as a public equities manager myself, I actually love the private markets because they don't have a daily centralized clearing price. That daily centralized clearing price is frankly nonsense on most days. The idea that if we take NVIDIA, I think you and I were mentioning it earlier, or maybe you were mentioning it earlier, that it was a $3 trillion company. Now it's a $2 trillion company. Maybe it'll go back to $3 trillion in a month. I'm talking about the market cap. Those movements are nonsensical. The value of NVIDIA hasn't changed by $1 trillion over the course of a few months. And, sometimes you hear somebody sitting in my seat as a public equities manager get a little testy and say, well, I wish I could mark my own book. I think that's absolutely wrong. I think the proper mark is as a business manager running a business would market, which is to say, listen, I've got a multi-year plan here. If, 1 month, 1 quarter, even a couple of quarters goes awry, that doesn't mean I'm changing my strategy, changing my business plan. In the private markets, you get to stick to the business plan and not be whipsawed all over the place by what the public markets are doing. You alluded to that earlier. I just wanted to let you know that's how I feel. I think this is why private markets have a very important stabilizing role in an asset allocation, and not just the same as investment grade bonds, which today will give you a decent after inflation return, but not that much. You can get good return from the private markets with stability.
Agree. And in that sense, private markets are more boring, if you will, because it's just an anchor in your portfolio and not something that jumps up and down. So in that sense, steady cash flows, stable returns, long horizon. Of course, investments, as we all can agree, exactly as you're saying with NVIDIA, should not be something that moves trillions up and down in a short period of time, even if those things have nothing to do with NVIDIA. I couldn't agree more that you need something that's more stable, something that's just more humming in the background. And then, of course, some allocation to the more, again, adrenaline rush driven equities or parts of the market. Of course, it's one way to construct your portfolio. Others may say, I'm not really interested in adrenaline rush. Let me just try to construct a portfolio purely with the purpose of getting income and getting a cash flow. And then it's possible to be much more significantly in the private markets relative to someone who might only love the adrenaline rush and say, oh, I only want to invest in the Magnificent Seven. So that's all personal preference of risk. You know much more about this than I do. But the preference for risk tells you something about, well, what type of asset should I have in my portfolio?
What wakes up Torsten in the middle of the night? What is Torsten when he gets up? And hopefully you take a long time before you look at your phone, but what is it that you're like, oh, I can't believe that just happened? Or what is it? What wakes you up?
I will say that what has, of course, had me and the rest of financial markets a bit worried here in the last few weeks is the unquantifiable risks that we're facing. In other words, what is going on with the basis trade? Are there systemic risks? What's going on, for that matter, even with the trade policy? What's going on with retaliation? What is the overall things that we're talking about in markets? And can you and I, when we go back to our computers, can you and I put that into our spreadsheet and try to figure out what does that mean for our model for where the S&P should be? What does it mean for our model for where GDP should be? And the more unquantifiable the risks are, and in some cases, and I have no political views, and I'm 100% sure you also have no political views. We just try to figure out what's going on. It is just the case that in some countries, not only in the US, but also Germany, just decided from one day to the other to spend $500 billion on infrastructure and spend unlimited on defense. I mean, unlimited, that's a pretty big amount. And if you go with that, how do I quantify, how is this going to be implemented? How quickly will it come? Which companies will be benefiting? Certainly things are decided by politicians in the US, in Germany, around the world, in China also, where you need to say, how do I quantify that risk? So I try to look at my screen every day and figure out, is this a risk that is having implications for my outlook and what I'm saying? And how do I quantify the magnitude of this risk? And in many cases, it's really, really difficult. But that gets us back to then what we spoke about in the beginning. That's why my approach has been to say, I don't really know exactly how to quantify this risk, but it's probably negative or positive. But let's say it's negative. So let me look at some of the indicators that this risk should be impacting. For example, how many people go to Broadway shows? How many people fly in airplanes? How much money is spent on debit cards every day? We also have indicators at the moment for daily job openings. Are these indicators telling me that this shock is serious, or these indicators telling me that this shock is not serious. So in some sense, the data hunt and the data purpose is really to try to figure out how important is this shock that I wake up like you in the morning and say, whoa, I hadn't thought about this. Let me try now to figure out, is this actually having an impact or not? So instead of me speculating, which, and you and I have important opinions and we can have a view on whether this is important or not, then ultimately I try to look at what is the evidence that this is actually playing out. And in the current context, what is the evidence that all this soft data, consumer confidence is weak, CapEx planning by companies is weak, and if corporate confidence and consumer confidence is weak, what's the risk that that's going to slow down the hard data and therefore ultimately slow down actual spending decisions by companies and spending decisions by consumers. And we're literally, in my view, at the inflection point where we will soon begin to see the hard data weaken simply because of the significant weight of the weakening of the soft data.
Torsten, everyone is seeing through your gracious and generous amount of time with me today that you are the intellectual engine when it comes to economics at Apollo. And by extension, we're seeing how great Apollo is. And clients are already seeing that by the inclusion of Apollo strategies in their portfolio. I'd like to know a little bit more about the economic engine behind Torsten. Who were your mentors? Intellectually, emotionally? You're a very unique person. I'm going to do this now. The way you carry yourself in the world of finance is exemplary to me as a person individually. We operate in a world of some big egos, some really big egos. And those egos quite often come across as, I'll be gentle and say bombastic. And yet every time I've seen you interact, you don't get into the mud. You're not throwing rocks with anybody. You're coming at it with your intellectual firepower. It's hard to imagine you getting ruffled, getting out of your comfort zone. How have you developed that, both professionally with examples in your life and personally?
Well, that's a very, very fundamental question. And I, of course, understand what you're saying because in my view, and I will give you the example, I have a 16-year-old daughter, and she told me several years ago, you always have to be nice to people. And if you go out there and you are not nice to people, then it may be okay in some situations. You do have to not be nice to people. In some situations, things can get really bad and tense. So then you do need to say, this is what my view is, and we're stopping here. But if you start out with a premise that this is someone who's friendly and I can be friendly, let's try to figure out a way to discuss what the economic outlook is, what things are happening, what's going on, and what things are happening in financial markets. If you always are nice to people, you will come a very, very long way. That doesn't mean that you should always be nice under all circumstances. If someone really treats you very badly, it's okay if you really start saying, well, this is not very nice, and now I need to tell you that this is not okay. But broadly speaking, if the starting point is always be friendly, always be nice, I think that gets you very, very far. So with that premise, who has been my mentors? That has actually been people that have been very, very nice to me. And I'll mention that these are probably people on your podcast here may not know, but there was a professor in economics, Niels Thygesen in Copenhagen, who was always extremely nice, very gracious, very good with his time, and taught me how you should carry yourself and how you should behave yourself. There were also people at the IMF and also at the OECD. OECD, one mentor was Vincent Cohen, who is still there today at the IMF. It was colleagues like David Fokas-Landau and Pinky Chada, who works at the Deutsche Bank at the moment. And those people always, of course, have told me that it's all part of the analytical work. But if you combine that analytical work with also being nice to people, I think that is part of the recipe for at least having a lot of fun with what you do, and also having a good debate and a friendly debate where you can say, I think the stock market will go up, and I can say the stock market will go down. Then instead of just saying, oh, you're stupid, that's a bad view, then instead say, you know what, let's discuss what are your arguments, what are my arguments, let's take the scale out and keep it as a neutral. It's not about you or me as a person, it's really more about let's put the arguments and put the weight up on the scale and figure out what arguments are. And you could put more weight on some arguments over here, I can put some weight on some arguments over here, and we will still be good friends when we walk at the door, because we still know that, yes, let's see what happens next time we meet. We may have the opposite arguments and we may have a different discussion. So the premise is really to believe in the good in all human beings and trust that our conversation is all about what we're having on the table and is not so much about you and about me.
That was fabulous. I mean, that was something that I am highly likely to go back to and remind myself by watching that what you just said repeatedly. It's something I totally agree with. It's something we could use a whole heck of a lot more of right now. Just be nice.
And that's always the easy thing if I'm run out of arguments is just to say, oh, this is about you or the way you look or where you're from or what degree you have even. So that's why it's not, and what university you went to. I know there's so much discussion in these circles about, oh, what did people do? Where did they come from? But at the end of the day, it is the merit of the arguments that ultimately matters.
Boy, you nailed it. You nailed it many times in our session today, Torsten. I think I'm going to draw it to a close today, but with a great deal of gratitude. I knew I would be grateful coming out of this time with you. I'm more grateful than even I had imagined.
Thank you for having me.
You truly are a marvelous human being, a wonderful economist, and a gift to the industry of finance. Thank you.
Much appreciated. Thank you. Great. Thanks for having me, Jim.